Hi, this is Justin McNichols with Osborne Partners. In today's video, I'm going to talk about an important shift that we believe is going to occur in markets. So 2022 is now the ninth worst bear market since 1950. And there have been a lot of worries that investors have had throughout the year. Those have included the Ukraine war, China's COVID policy, inflation, rising interest rates. But with all of those worries in mind, we believe that a shift in investor focus will begin in the fourth quarter of this year. And I'll tell you what we're talking about. Well, first, this is what the ninth worst bear market in 70 years feels like. What we have listed here are the 14 bear markets that have fallen 20% or more in the past 70 plus years. And the highlighted one there is the 2022 bear market. Now, some interesting facts. First, the average bear market has fallen about 32%. But if you exclude uh, the internet bubble, war, or pandemics, basically the average bear market falls about 24%. This particular bear market in 2022 has fallen 25%. The duration, they typically last between 8.5 and 11 months. We are now entering in a few days, month 10 of this present bear market. So we're right around the average duration of a bear market. But of course, the most interesting part about these major bear markets are where the S&P is a year later. And on average, the S&P is 40 to 44% higher a year after these major bear markets bottom. So let's look at the worries that investors have had throughout the year. And the first one is Russia attacking Ukraine. The idea that investors worried how long the war would last. Would it escalate? What would happen to the energy supply, mainly to Europe? And would that cause Europe to go into a recession? Well, those worries are always present, but they don't seem to be the riskiest at this point. And we'll have to see how the war progresses. But this is kind of pushed outside of the main worry that investors had earlier in the year. An additional worry that investors had earlier in the year was China's zero tolerance COVID policy, and the worry that China potentially would fall into a recession, that it would affect major trade partners, including the US and Europe. And this policy, this very strict zero tolerance policy, the question was how much it would hurt commodities, especially things like industrial metals that China consumes more than any other country. Um, Investors, markets, and economies at this point have become very used to their zero tolerance policy. And in general, we seem to see the zero tolerance policy really isn't as detrimental to the overall global economy as we first thought in the beginning of the year. But as we move on to two of the more important worries that have expanded globally, number one is inflation. We've had spiking inflation, as everyone knows. But we believe inflation peaked in June 2022. A lot of the economic metrics are confirming our thesis. And additionally, some of the lagging metrics like rent are starting to normalize here. And we should see these lagging indicators start to normalize in the next month or two. But what we find interesting is when you look at things like the 5 and 10-year inflation break-even rates, they continue to be below 2.5%. So these worries of inflation being extremely long-term, the break-evens are telling us that inflation is certainly going to normalize, and that's going to be less of a worry, especially as we move through the rest of the year. And finally, worry number four are interest rates. There are a number of different charts that I can show you that show these huge spikes in interest rates. But the example we want to use here is the US Treasury 2-year note yield. And as you can see there, down in 20 and 21, this yield was practically zero. And here in very late September, we've got a yield at over 4.3%. So that's quite a spike in interest rates. And there are a lot of fears that these interest rates are going to go a lot higher. This is not a fear that we necessarily have. We think that the majority of the Fed funds increases are behind us, and potentially most of the move in general interest rates higher. We've seen most of the move in this cycle. Doesn't mean they can't go higher. We do believe they will go a little higher, but the majority of the move is behind us. So this is where we move into what we feel will be the focus of most investors going forward. So with the war aging and the COVID policy becoming old news and inflation peaking and interest rates approaching a likely peak, we believe that investors will start to focus more on corporate earnings. And that will be one of the main things that investors look at, along with the multiple that you attach to those earnings. So in the next slide here, we have a grid that shows different PE multiples along with different estimates of earnings per share for the S&P 500. Now, history to us points to a terminal trough PE of somewhere around 16 or a little bit less. And where we derive that number is from the average PE compression during bear markets. And that average compression is very steep. It's 30%. That would put us at around 16 times earnings. And so next we need to estimate what the 2023 earnings that started the year at $2.55 a share, what those will be next year. And as you can see here, we've got these different columns that show earnings everywhere from $230 a share down toward $200 a share. And where you have the areas that are green and shaded, we think that's probably the risk in markets for the S&P 500 and for domestic equities. And as you can see there, it falls between 15 and 16 times earnings, with 2023 earnings estimates being somewhere between, call it, nearly $210 up to nearly $230 a share. And that would put you somewhere in the range of the mid 3300s to the mid 3600s for the S&P 500. And we're actually already in that range right now. So we're thinking somewhere in that range, putting us at kind of an average recession with a terminal multiple that you typically see in bear markets. So that addresses domestic equities, but one of the more important things to look at is the fact that multi-asset class portfolios capture less downside. A lot of us know that the majority of professionally managed portfolios, they basically have US stocks and bonds. It's mainly two asset classes. But if you look this year, if you had a normal average portfolio at 70% US stocks and 30% fixed income or US bonds, it would be down 18 to 20% so far in 2022, which is brutal. It's a bear market in itself. You look at how Osborne Partners manages portfolios, and as you know, we manage over 6 asset classes plus cash. The average Osborne Partners client has 50 to 60% of their portfolio allocated to these 2 asset classes. So if you look at an average portfolio that we have allocated over 7 asset classes, while US equities are down over 20%, in fact, it's 25% in 2022, there are 3 asset classes that have actually posted positive returns for the year. And that's our whole philosophy of capturing less of the downside, which is mainly the key to achieving strong long-term returns. So a couple lessons here and observations. Observation being that investors are going to start focusing on earnings and less on interest rates, inflation, China, or Ukraine. And secondarily, when you have a portfolio that's allocated to 7 asset classes, you typically are able to capture less of the downside when you experience one of these awful bear markets like the one that we're in, that's the ninth worst since 1950. Thank you for listening to the video today. We hope you got a lot out of it, and we look forward to investors focusing on earnings as we head into the fourth quarter of 2022.